Good morning, folks. Welcome to this week's edition of Back to the Futures with me, Markets and Mayhem. It's Tuesday, January 20th, 2026, and we are set for another tariff tantrum. In fact, this week's Back to the Markets is going to be called the Tariff Tantrum Edition because it looks like markets are pretty upset that we are reinstigating some of these trade tensions with Europe over the idea of acquiring Greenland. So that's what's on the mind of the markets this morning, causing a fair amount of volatility across multiple asset classes. And we'll be talking about that today. We'll be talking about some of the things leading up to this, that even though we didn't know that this specific event was lying ahead of us, we did see signs that markets were getting stretched. So it wasn't particularly surprising that any kind of negative headline could start to push things lower. And that's exactly what we saw play out today. So first, let's just talk a little bit about risk. Always manage it first and foremost. If you want to stay in the game, in this business we call trading, you absolutely got to manage your risk first and foremost. There is no way around that. And I say that every week because I see a lot of people getting hurt on the regular, not managing that risk. The other part about it is have a system that you're actually trading against. You need to know what your setups are, what works for you. Everyone's wired a little differently. So one of the things I highly recommend doing is keeping a trading journal so that you can start to take into consideration what trades are working, what trades aren't working, and lean into what works. Find that talent and lean into it. We all have an edge we can build based on how we're wired and what trading setups work best for us. My thought is let's lean into that edge. Once we start to discover it and build it, let's lean into that edge. We don't need to trade how other folks are trading. We need to trade based on what works for us specifically. That's one of the most important things that I think we can take away outside of risk management, journaling that trading, learning what works for us, and building into that as a system. And I've been trading for 20 years, and I can tell you, I still journal my trades, and I still think it's a very important part of trading. And a bit about me, I did date myself there a little bit. This is actually now my 21st year of trading, 20 years of investing under my belt. It's been a wild ride. I've actually enjoyed it quite a bit. It's both about enjoying the process. And once you've done this for a bit, you figure out it's not just about the goal. It's not just about building wealth. It's actually about enjoying the process, building those skills, and then the rewards come to you naturally. When you're managing your risk first, when you're leaning into a system, when you're building that edge and trading with discipline, the rewards come to you. And part of that for me was discovering that I'm a much more systematic trader, that I am much more data driven. I'm not a fly by the seat of the pants discretionary trader. And there's nothing wrong with that. If that works for you and you can show that you have results that consistently beat your benchmark doing that, more power to you. But if you can't, if you're struggling, if that's not working for you, consider taking a more data driven approach. Consider running studies, consider back testing strategies and figuring out what works for you and in the market regime we're in. And that was one of the reasons that I founded Traderade in 2022, was to try to help pay forward some of the knowledge that I've accumulated along the way, and that I've also been fortunate enough to get from mentors and other folks that I was experiencing, just basically a big acceleration in the early part of my journey. I was able to meet value fund managers, growth fund managers, folks that ran trading desks at different types of institutions. And that helped to sort of fast track my thinking because, if you only meet one of those types of people, let's say you only meet a growth fund manager, and that kind of sets the tone, then you're going to ignore value. You're going to ignore swing trading. You're going to kind of just be a growth investor. And there's nothing wrong with that. People have done very, very well being growth investors. But if you have the experience of talking to growth folks and value folks and folks that are doing swing trades, it kind of opens up your mind that there's multiple different time frames, there's multiple different disciplines for how one can approach investing and trading, and as a result, there's no one correct way. It really is about how we're wired, what works for us, and then implementing that into a system that we can build with some degree of consistency. So let's talk a little bit about what's going on underneath the surface in these markets. One of the charts that I shared last week on social media was this Bank of America bull and bear indicator. And I've been talking on the Traderade Discord for some time about how the markets were starting to get a bit stretched. Really, in the last 2 weeks, we've seen more and more signs that positioning, flow, and sentiment were getting pretty bubbly in the S&P and to a lesser extent the Nasdaq, and that was giving us a sense that we could consolidate and pull back, especially if we got some sort of negative catalyst. We of course got that in spades over the holiday weekend with the re-escalation of trade tensions with Europe. And so we are starting to see some of that extended positioning showing signs it's going to be coming off this week, which makes sense. It's not the worst thing. We're also post options expiration, so we've got a lot more room to move. We're unclenched from that gamma exposure, which tells us, we could get a decent move lower out of this, shake out some of those weak hands that have been buying in closer to the top of this range. And as a result, in all likelihood, we do resume the uptrend. In all likelihood, we do continue marching higher, but we've got to shake this thing out. And also, we've got to see whether or not we do see a taco, whether or not Trump backs off from some of these threats. If he does, I think the markets march right back higher. If he does double down, and he basically starts to instigate a new trade war, then I think we could be in for a bigger correction. Eventually, again, it'll shake out. It'll be in the rearview mirror, and we'll be going higher. But it's a matter of how long does this take and how deep does it go? And a lot of that has to do with the decisions that are happening from policymakers in D.C. This is that sort of big picture macro that can impact markets in short time horizons all the way through much longer time horizons. Another example of that impact is what's happening in precious metals, of course. Now, moving back to the markets, this is a chart of the New York Stock Exchange percentage of stocks above their 20-day moving average, and we can see 74% of those stocks are above their 20-day moving average. What does that tell you? We're stretched to the long side. So yet another confirming indicator that positioning was getting stretched. We can also see that in NAAIM, and that's a aggregation of institutional positioning. It was also getting stretched to the long side. Suffice it to say, there was a number of different indicators for equity markets that were saying, you know what, we could do with some consolidation or a pullback here. Otherwise, it starts to become more likely that we're going to cap out because of just how long everyone is. And you think about it, if everyone gets on one side of the boat, like everyone's on a boat, we're on the lake, we're all on the right side of the boat capsizes. So it's the same thing with market positioning. If everyone's in the same position and there's no one left to buy, it gets lopsided. You can see some volatility come in. And that's exactly what's happening now with our negative catalyst on trade. Another thing, though, to keep in the back of your mind is it's not just about trade. There is another element to everything that's going on that I think is important to pay attention to, and that is what's going on with the hyperscalers and the AI growth story. One of the things that's happening in the AI growth story right now is we're starting to see some signs that the CapEx growth is going to slow. That's kind of a big deal. And the reason that's a big deal is a lot of the economic growth that we've seen, as well as a lot of the earnings growth we've seen for the top of stream pick and shovel sellers in this AI gold rush, has been predicated on this CapEx growth, this AI related CapEx growth. So I do think that's important. It's something that we need to pay close attention to. And as we get into quarterly earnings, we'll probably get some more color about that from different market participants. The hyperscalers like Microsoft, for example. Microsoft was one of the companies that actually in the earlier part of last year started to give signs that they were going to shift up how they approached their AI investment. And the reason that matters is because we actually saw Microsoft give us signs that they were getting a little bit concerned about the amount of spending that was going on in that space, particularly their own commitments. And so they were showing signs that they might actually slow that spend. Now, they ended up changing things a bit. They actually did something very intelligent that we've seen other companies start to mirror. They've started to shift up how they're investing. Instead of directly building out their own capacity, they're doing investments with some of these so-called neo-cloud companies. And these neo-cloud companies, essentially it gives them a safer exit if that doesn't work out. IREN being one of those examples of those neo-cloud companies. So the reason that I mention that is that we've started to see some of the hyperscalers already show signs that they're going to kind of insulate themselves a bit here, which makes sense. But now we're going to hear during the earnings season that's coming up a little bit more color about all of that. Perhaps we might hear some companies talk about the issues they've had with data center deployment as well, where there's been more communities that have started to push back on developing data centers, sort of this not in my backyard NIMBYism. But with regards to data centers, and it makes sense in a way. They can be noisy. They can add to pollution with the diesel generators or natural gas generators they use for backup, but also they can add to your power bill significantly. And so there's communities that are saying, you know what, I really don't want to have to deal with that. So we've seen dozens of data center plans canceled or delayed as a result of that as well. There's also power constraints. Quite frankly, there are a fair amount of areas where there simply isn't the infrastructure to bring a data center online easily. In fact, Elon Musk's data centers in the XAI data centers in Tennessee are running into this, which is why they brought on modular natural gas burners to supplement their power. But now they're dealing with some issues with state authorities that basically they didn't have permission to do that. And the infrastructure doesn't exist to otherwise supply that power. So again, there are some headwinds, not only outside of the practicality of the scale of what's been discussed, but also the core limitations. We can see that in memory. We can see that in NAND, in flash. And so this is RAM memory and solid state memory. The prices have surged. There's backlogs going out through 2028 in the orders. So there's a lot of different bottlenecks throughout what's going on in CapEx that could both slow spending, but also cause companies to pull back a little bit. So we're going to want to hear some more color. And it'll be interesting to see what we hear from that, because if there is slowing in this CapEx growth narrative and in the generative AI growth narrative as a whole, this could set up a really interesting opportunity in international equities. You can see global equities, the ratio between them and US stocks is completely blown out. And there's reasons. It's not like the US is in a vacuum. There's the whole AI narrative has been really powerful and has helped to drive the US, as is just the growth in the tech stocks that we have here that simply are extraordinary. They are extraordinary companies. They have their issues, they have their limitations, but overall, these are uniquely American stories that we have that really we haven't seen around the world duplicated. So there would need to be some significant upheaval in that narrative for this to go the other way. But if it did, I think it would set up for a pretty amazing trade in emerging markets and some of the other parts that are cheap. I posted a chart out on social media about the relative valuations of emerging markets versus some of the developed markets, including the US. And the emerging markets are, from a fundamentals perspective, incredibly attractive here. Even Korea, after the run it had last year, and I consider Korea more of a developed market, also pretty darn attractive in terms of its valuation. Another area inside the US that's attractive, small caps. The S&P 600 small caps trading at a PE of 15 versus the S&P 500 at 22. That's giving us a sense that there are opportunities outside of the mega caps, outside of the S&P 500. This, in fact, is the S&P 600 small cap index. And this is something that we've been on top of. My partner Aisha is saying small caps are the way to play the Fed cutting cycle. They've also been the favorite short of a lot of hedge funds. So you get this kind of double whammy effect where on the one hand, you've got folks wanting to buy small caps from a valuation perspective, from a where we are in the cycle perspective, because they tend to benefit from rate cuts, reducing their cost of capital, increasing risk appetite. But also, we've got hedge funds having to cover into this because this is the favorite leg they have of their trade, their long short trade. They love buying NASDAQ, shorting Russell. That's not working lately. In fact, it's blowing up in their faces, so they're having to degross or take that leverage ratio down, which has also been bullish for the small caps, leading the Russell to have one of its best starts ever. And certainly its best start versus the NASDAQ ever. Now let's take a look at the S&P 500. This is one of my long-term swing pivots charts. And what we're seeing on this chart here is that we've rolled below a pretty key pivot, the 6924.25. And it does look like we've opened up 6810.25 as an area to the downside where we could base out from this move. So that would suggest we could have another, 60 points lower from where we're currently trading pre-market here. Wouldn't be too surprising. We can see this has been an area of repeated resistance and support going all the way back to late last year. So watch 6810.25 to the downside. I think that's where this move is going to cap out near term. Whether or not we keep correcting from here has a lot to do with policy. It's going to have a lot to do with whether or not cooler heads prevail on this whole Greenland situation, or if we see it escalate. Personally, I hope cooler heads prevail because I don't think this is going to be something that has a particularly constructive outcome. I don't really see a lot of reason for, us to try to acquire Greenland in a way that burns NATO and key trading partners and buyers of our debt. Speaking of which, we've seen the 10-year breakdown. This is another thing I've covered on social and on the Traderade Discord, that rates on the long end are going up. This is bad for growth. It's bad for risk. It's essentially repricing what we're seeing in terms of expectations about the fungibility of U.S. debt over the long term, about what the dollar is going to be worth in 10 years. And a greater term premium is warranted. That term premium being the difference between the rate on, say, a 2-year note and a 10-year note, where if you're taking a longer time frame of risk, you should be paid commensurate with that risk. Term premiums continue to go up. That's another one of my base cases for this year, that if you're investing on the long end, you're not being paid enough. And so I do think yields can go appreciably above 4.5% on the 10-year. I think in doing so, it is going to have a negative impact on some of the growthier, riskier parts of the market, particularly the tech stocks that have had such a great run might pull back, specifically some of the mid cap and small caps that are a little bit more questionable on the profit side. Let's take a look at the S&P 500 options chain. 6,800 is a pretty big level of implied support. That's a put wall under price. So that's going to be another area we're watching today, just above that 6810.25. This is going to be about 6835 or so. We'll talk about it when we dive into Bookmap when the market's trading. Got about 10 minutes until the opening bell. Another thing I don't like seeing is this Wyckoff distribution pattern on the S&P 500. I was hoping this wouldn't play out, and it did look like we finally kind of broke out of that long-term trading range to the upside. But after all this, it's starting to look like that might have been a fake break as we are rolling lower. So the last thing you want to see is kind of what's happening right now in the market, where we're breaking below that trading range. Now, the bottom of that range, I'm going to say, is 6810. So we broke below the near-term consolidation range. You can see that push lower this morning. If we break below 6810, this starts to look a lot more like a Wyckoff distribution pattern. And, I think that would take us down quite a ways, probably down to about 6,529. So 6,529.75. If this is a Wyckoff distribution pattern, that's the downside I'd look for. It's pretty chunky. That's some pretty chunky downside if we are able to realize that outcome. It would certainly set up some interesting buys too. If we get down there and we base, I'm making a shopping list, and I'll be looking at some long-term swing trades and investments if we have a better shakeout from the kind of saturated levels we're at now. So that's what we're looking for, is whether or not we can hold 6810.25. And again, it's all about cooler heads prevailing. We'll see whether we get a taco out of this or not. Then we have the NASDAQ. NASDAQ chart looks quite similar to the S&P. We're looking at major support around 24,976.20. If we do break below there, 24,063.75 opens up. So it's a very similar setup to the S&P. We've got this major level. It's not too far below us. And this is kind of predicated on, again, cooler heads prevailing, or we can continue to correct lower in the NASDAQ and in the S&P, really across the U.S. markets. And I would be looking at the top of cloud here as well. This is the Ichimoku cloud. On each of these charts, that represents the health of the trend. So the fact that we're above the cloud now puts us in an uptrend. Obviously, that looks real shaky. If we get into the cloud, we're no longer in a trend at all. And if we break below the cloud, we are in a downtrend. I like to look at those on a closing basis to get that trend health assessment. But right now, the NASDAQ, the S&P, the Dow, the Russell look pretty heavy, and we have a negative catalyst on deck with these trade tensions. And Trump this morning doubling down, saying he's not going to back down. So again, we'll see how that plays out, but that's where we are right now. Gold, on the other hand, breaking out of this channel. And we talked about this a little bit in the prior weeks that, it kind of looks like a bear flag, but, it's got to actually play out to become one. Well, when you have a bearish pattern and it doesn't play out, it tends to have a pretty powerful bullish resolution. Obviously, no one except for the insiders at the White House and in this administration would have known that this new uncertainty catalyst was on deck specifically for this week. The timing couldn't have been better for this because it looks like we're going to hit the top of the channel and kind of reflect lower to the bottom of the channel. Instead, we're breaking above and starting an acceleration phase in this uptrend in gold. So I think gold 5,000 is a no-brainer here for this quarter. I think we're going to be getting there sooner than later. And I've talked about this with the precious metals repeatedly, that one of the biggest reasons that they love this environment is uncertainty. Obviously, they are also quite happy with the abundance of capital being spent, this fiscal impulse that's happening from the past two administrations, really growing the deficit spend, making the government a bigger, more important part of the economy, but at the same time, debasing the dollar. The more you spend on deficit, the weaker the dollar is going to become. And so we're certainly seeing that priced out in commodities and particularly in precious metals. And I'm still very structurally bullish on gold. I think gold can hit 5,000, consolidate, and probably get up to at least 6,000 this year, possibly higher, if this uncertainty trend continues and if the Fed leans further into rate cuts, which it seems likely, as the new chair will likely be in favor of much lower interest rates. So that all looks good for gold. For silver, I'm still structurally long-term bullish. So don't get me wrong, but near term, I am a little bit concerned about how blown out this volatility skew is. And what that means is you have a lot of positioning on the call side here. It's very lopsided. It's so lopsided that, in fact, if silver was to just go sideways in price, you still have a negative liquidity effect of all those calls losing value through theta decay and dealers selling their exposure in silver as those deltas drop. So really, silver just has to keep going up or the negative effects of this skew can amplify. This is not a top call by any stretch. It's more of a yellow flag you put out there saying everyone's on one side of the boat. This thing's getting a little lopsided. If you have a negative catalyst, it could get a little nasty. And speaking of, well, just rushing in, this is us. This is retail. Retail net buys in silver from Vanda Research. Incredible levels of speculation from us home gamers in the white metal. So just be cautious here is all I'm saying. There's no reason silver can't get to 100, tag it, but I'd really love to see it consolidate. I don't like parabolic moves. If you look at the chart of silver right now, it sure looks parabolic to me. We need a correction or consolidation phase to kind of build some more healthy structure and shake some of this out. That's going to be really, really, really important in the weeks and months to come to make sure that we don't have this turn the other way violently, if not more violently than it went up. Now, I don't see that as a highly likely scenario with everything going into this move, but it is something we have to keep in the back of our mind because commodities, well, they tend to move in cycles. And when they go violently higher, they can just as similarly go violently lower. So if we can't shake out that parabolic move sideways, build some healthy structure, the corrective impulses become more risky to the downside. And finally, we've got Bitcoin on screen. Bitcoin, I was hoping to see this thing break above the cloud. It just can't do it. You can see that right here. It got right to the top of the cloud, it poked up few times in a row, poked its head above the cloud, and just really got stuck. So that's another thing I don't like seeing. And you're seeing it also break now below the EMA 21 ahead of today's trading session. So overall, seeing weakness in crypto, which is a relief valve for speculative liquidity. It's also a bit of a risk appetite barometer. That's another negative sign ahead of the market today. So here are our weekly pivots. I'll be posting these out on social media as well. Just posting those out there right now. And definitely want to alert y'all to some solid deals we have going on. You can get up to 20% off Traderade using the code Mayhem20 at checkout. And if you haven't picked up a copy of Bookmap yet and you want to check it out, visit traderade.com/bookmap. Scroll down to the special offers for up to 40% off your first term. And some cool events coming up. The crew at Bookmap presenting a event all about how institutions move markets. That's going to be on the Bookmap Discord tomorrow, January 21st at 1 p.m. Eastern. So be sure to check that out. And let's dive right into Bookmap here. And I'm also going to just check around, see if anyone has any questions about what I've been talking about. Good morning, Dvorak. Good morning, Paul. Good morning, Dan, George, Guybert, Antonio, Low Key, Satoshi. Good morning, everyone. Good morning, Stephen. What's my opinion on altcoins? Um, so actually, there's an interesting statistic about that. Let me see if I can find it because this will help to color my opinion a little bit. Okay, here it is, and I'll paste this into the Discord here. More than half of all crypto tokens have failed, and most of them died in 2025. Over 13.4 million tokens have been erased between mid 2021 and 2025, according to a new analysis by CoinGecko. So, kind of gives you a sense that most altcoins don't survive. And even if they don't fail, often is the case that they lose a lot of their money. Now, I can understand why people speculate in altcoins because I don't think Bitcoin's going to have another Bitcoin move again. Like, I don't think, Bitcoin at 90,000 is going to go to like, 9 million or any of that. I'd be super duper surprised. But I could see, maybe some altcoin somewhere possibly gets like a 1,000x or a 10,000x if it has some use case, if it has some powerful catalyst, mass adoption. I could see in the back of people's minds why they'd think that speculating there could make more sense than speculating at the top level, like the Bitcoins, the Solanas, the Ethereums, etc. I could kind of understand the appetite. It doesn't resonate with me personally. I still think there are better risk to reward opportunities and equities and futures and options. So I'm not playing around with the altcoins myself. But for the people that are like way out there on the highly speculative appetite risk curve, I could understand why they might start to look at altcoins more bullishly in a new Fed rate cutting cycle, where also on the fiscal side, there's a lot of irresponsibility. If liquidity comes back in a big way, as it may, with the president kind of pushing on the Fed to cut rates further and further, you could have a pretty chunky move in some of those coins. All right, markets are open. We're getting a bit of a pop off the open in the S&P 500 here. We're just going to zoom in a little bit more on the time frame. And Stephen's passing on a question about stable coins in my view. So I will admit I am probably not 100% up to date on all the developments in stablecoins. There's been a flurry of different headlines from major banks and other companies like PayPal and, just kind of all over the map discussions about stablecoins, even some potential discussions about central bank digital currencies in the future. I think stablecoins, if they're actually backed by something used for transactions, could be interesting. Um, I think there is something to that, to settling transactions on a coin that's backed by something tangible. Personally, I'd like to see stable coins backed by gold become a major thing. I think Tether has talked about and possibly even bought a lot of gold, if you believe their statements, which, there's some skepticism there. But I do think that they have a role to play. I do think that stable coins could be another instrument that's sort of like a more liquid reserve instrument. But I don't think they're going to be great vehicles for speculation, because the whole goal of a stable coin is that they're stable and they're just basically one to one with whatever they're priced in. And a lot of them are backed by dollars or, other major currencies, things like that. So I think that they're going to be valuable for kind of acting as a foundational vehicle for transacting, for treasury replacement, other areas like that. And the more that the US government uses the dollar as a weapon and uses trade as a weapon, you could see things like stable coins in other currencies and, maybe backed by a basket of precious metals or just gold become more of a thing. That's obviously longer term thinking, but I could see it because it has some practical value for de-dollarization, something that I think will become more of a trend if all this geopolitical tension continues to build. So looking at the S&P 500 here, we're just sort of chopping between a range. I've got a pivot on one of my other screens at 68, 64-ish. I'll hone in on that number in just a moment. Yeah, 68, 64.75 is going to be a pivot to watch. As long as we're above there, that's been an area of support. We've been kind of chopping above and below overnight. Let's see if we can zoom out a bit. So there's this area right here. This is it. This whole line has been around that 68, 64.75 level. Seems like when we get above it, we get a decent amount of buying. When we push below it, you see follow through from sellers. So I'm going to mark that as our line in the sand for today's session, not the weekly pivot, but today's session, 68, 64, 75. Now let's take a quick look at the S&P 500 heat map here as the market's open and trading. I'm just going to bring this on screen for you all. We could see pronounced weakness in tech, but it's really across the entire market. There aren't a lot of safe areas today. Now, you do have a bid in Micron, you've got a bid in Intel, so there's some exceptions to the rule. Western Digital, Seagate, SanDisk, the storage plays, also getting a bid, a little bit of a bid in some of the energy stocks, but overall, this is a pretty distributive heat map. And underneath the surface, 78% decliners versus 18% advancing. So really, really nasty distributive breadth across the market here. In futures, precious metals bid well. Gold trading 47.48, getting a little bit of a pullback after the U.S. market open, but still having a pretty solid day. Silver up almost 7% as well, pulling back a bit from the U.S. market open, but overall having a pretty solid start to the week here on the back of these trade tensions. And silver's order book remains bid heavy here, about 2-to-1 bids to offer. So I would expect this could reverse pretty soon. We do have some decent bid side liquidity just below us here at 94 and 93.85. Bitcoin mostly consolidating this morning. But in the overnight session, down about 5%. Pretty decent liquidity coming in to Bitcoin around 90,480, though. About 322 contracts on bid down there. And let's get back to the S&P 500 here from the open. We're just going to do a 10-minute window. Certainly looking at a pretty decent implied opening range here. Looks like it's going to be about 17 handles so far. So it sets us up for a reasonably dynamic trading day. Crude popping up over $60 a barrel this morning. Interesting that really since the open, there's been this steady drip of iceberg selling. You can see that now, negative 1,730. It's not an enormous amount, but it just seems like as soon as the market opened, you saw a trading desk leaning into passive distribution here. This on the backdrop of a pretty strong CVD on the other side of it. So they're just selling into strength. The buyer's starting to get a little bit more aggressive here. I'm just going to zoom out once again just to see the broader trading range that we've had. See, we got back to the top of that pre-market range and started to see some sellers come back in. So suggests there is still some supply, probably some trapped longs up there from earlier. I'm going to zoom back in. This time we're going to take it to a 5-minute. Also seeing vol catch a healthy bid here, and we do have expiration this Wednesday if memory serves. Spot VIX up to 1960, up almost 6%. Safe haven currencies like the Swiss franc also rallying today, up 1.63%. The dollar falling, down nearly 1% today. Let's take a look at the NASDAQ. NASDAQ also having a very choppy start to the day, which makes sense given everything we're seeing in some of the individual heavyweights of the NASDAQ, including things like NVIDIA down 3.32%, Broadcom down 3.4%, Oracle down 3.4%, Amazon down 2.8%, as well as Google. Tesla, not to be left behind, down 2.59%, Meta down 2.25%. So just a lot of distribution in the big techs. Outside of Micron and Intel, it's pretty much red across tech. And so I imagine we see something kind of similar with the NASDAQ here. Let's see. Actually, NASDAQ was able to break above that pre-market area that the S&P saw selling pressure in. So the NASDAQ showing a little bit of relative strength on its recovery here. Worth watching. NASDAQ down about 1.7% here. So we're going to zoom back into that. We should start having some of our earlier day flows aggregate soon as well. I imagine they're going to be put heavy as folks should be buying insurance into this tape, with vol, even though it's appreciated, still being pretty cheap. And seeing S&P 500 futures prices push up above the point of control here. And they've held above that pivot we've talked about as well, the 6864.75. So overall favoring longs intraday. As long as we're holding above the point of control in that pivot, we've got room to the upside. We do see liquidity starting to stack above as well, suggesting there's interest in some of these higher prices. Good morning, Jonathan. Loki asks, unfortunately, I missed the ride on gold. When do you see it pulling back to the bottom of the channel again? So it's really going to be about simmering geopolitical tensions. Things have to cool down, I think, for precious metals to cool down. I would like to see precious metals cool down as well, as I don't like parabolic moves, particularly like what we're seeing in silver. And remember, I've been bullish of silver since like the high 20s, low 30s. This has been a great move. I've definitely done quite well in it in the physical holdings and the futures swings and the miners and things like that. But on the other side of it, you know, you can be super bullish and still want to manage risk and not see things move in ways that are dangerous. And having been around the precious metals markets through several bulls and kind of see how they can unceremoniously end when parabolic moves flip, I just want to see some constructive consolidation or correction to build the structure that we need in silver. For gold, its move has been far less parabolic in comparison, and it's actually had long periods of consolidation before it breaks out. So what I'd say for gold is you're kind of looking for that. It's not so much, hey, you know, when do we get to the bottom of the channel, as much as, hey, when do we get back into a period of consolidation? Maybe even a correction that leads to a period of consolidation. That's where I think that the time to buy gold is right. When people are saying, it's had its move, it's done, you know, the top is in, whatever, they're starting to throw in the towel a little bit. You start to see some more exodus from ETF holdings and options and gold miners. And this tends to happen. You know, you have these heights of euphoria like we're having now, and then you have these lows in the context of a bull market where people kind of give up because it's gotten boring or it's going against them, especially the late entrants. That's the kind of scenario where I'd want to buy gold. I don't know that it's a specific time or price level as more a backdrop. And you know, I do these every Tuesday. So once we get to a point where I think gold is a screaming buy or silver is a screaming buy again, I'll certainly be identifying that on the stream. I'll be talking about it in the commodities channel on the Traderade Discord with a, you know, much higher frequency of commentary. I try to weigh in on the commodities there at least twice, 3 times a week. But overall, I think right now is a good time to be a little cautious of getting long precious metals if you're not already long. And if you're already long, it's not a terrible place to take some profits, look for a little bit of a shakeout to buy back some of those positions. And we are starting to see some of that flow hit. Call demand is in the lead so far. We'll see how that develops. Right now, we got about 1,000 chasing the hot call, and that implies 69.76. So that's the same level we're at now with the hot call on screen. And between the hot call and the warm call, that's just about 2,000 chasing calls. The top 2 strikes versus the top 2 put strikes, about 1,250. So not quite a 2-to-1, but certainly some more favoring of upside exposure so far this morning. And zoom out just a little bit in the time factor. And let's actually, you know what? Let's pull back to that pre-market just so we can get a sense again as to where that supply is. So that supply level just overhead, we're going to say that's around 68.85. We want to see a push, a determined push above there. That would be the next thing that we'd really like to see to take a more bullish stance on this. But, you know, we're retesting the point of control. Would obviously like to see us stay above that area. We're not doing that so far. And also want to see us stay above that 68.64.75 pivot. So we've got a few lines in the sand we can draw to kind of get a sense. We also have that 20-minute opening range coming in. And we'll pull this back 20 minutes just to get that whole range. So we'll call it about 18 handles so far. That's not bad. It does set us up for a reasonably dynamic trading day. We see price pushing back above the point of control here. We've remained above that 68.64.75 pivot as well. So we really just want to get above 85 where that supply is. The last time we had that move, we got sold into. Not aggressively, but we did see some selling pressure. Basically buyers saying, hey, we don't quite have the demand to take us above some of these higher levels of offer where there's some implied supply from earlier. But I have a feeling on that next push, they could probably take that out because we haven't seen sellers really come back in either. Sort of a tale as old as time itself is that sellers tend to be far weaker than buyers, especially when you have such a big discounting during the overnight session. Basically, trading desks come in this morning and decide, okay, how much are these trade tensions going to affect the forward earnings of these major companies in the S&P 500, and also how much do we believe in these trade tensions, having gone through so many iterations of basically them not coming to fruition for one reason or another, whether a deal is struck or one government or another backs off or whatever the case may be. And so as you reprice that risk, you may have some room for upside after a pretty big discounting in the overnight session. I think that's part of what we're seeing in today's tape. Right back to that pre-market area where we know there's some supply. We can see some of it on offer overhead. So it'd be really constructive for the buyers to take us through this area. We've got more supply building overhead in terms of these limit orders that are continuing to stack. This is constructive overall. This shows you there's interest in higher prices. Now we need to see the buyers show they have the demand to take us there. We're also breaking above VWAP. We can see that has some confluence with the point of control. And once again, there are rumors being floated that maybe, just maybe this time, we'll get that Supreme Court ruling on tariffs. Would be really, really amusing if we did get it and they struck them down, and that's what resolves the European Union trade issues. It's not any governments or cooler heads prevailing. It's the Supreme Court saying no more. Markets would love that. They would fly higher, like 200 points. Not saying it's going to happen today, not saying that's going to be the outcome, but if it was and it did, I think it would be a surge higher near term because it would basically end this kerfuffle right then, right there. Maybe there'd be some additional back and forth. We're going to invoke this act or this power or whatever, but ultimately, I think the near term impulse would be one of relief. And we are starting to see put flow pick up now, which is something I was thinking we'd probably see this morning. So put flow exceeding that of call flow for now. About 8,000 on the top two puts, trading on the 68.26 and 68.31 implied ES levels. Now, I think some of that is hedging because of the event volatility catalysts we have, both unscheduled and scheduled. You got Supreme Court potentially, maybe they'll make their ruling. You've got what's going on with trade. You've got earnings season coming up. There's a lot of reasons to want to buy some insurance. And it's not super expensive here. So that could give us just a little bit of near-term heaviness in the tape. So one ruling from the Supreme Court expected in about 5 minutes. That's all over the news wires right now. So that's why I'm reiterating that. And I'll stay on the line just in case we do get that because it'd be pretty interesting. That would be very interesting if we get anything. I'm not going to hold my breath, but I'm certainly watching. I also think if we got a Supreme Court ruling that struck down the tariffs, it would be bad for treasuries. I think that would probably send yields higher on the long end, more than they're already moving. I mean, look at the 30-year bond. Futures down 1% on the 30-year. And U.S. Trade Rep Greer is saying there are other tariff tools if the U.S. Supreme Court strikes down tariffs, but they are most appropriate for the situation that the U.S. faces. And we are seeing liquidity drying up near current pricing, so the market's anticipating something. Typically, you see that happen ahead of an event volatility catalyst. Today, it's the potential Supreme Court opinion on tariffs. Put flow building about 18,000 the top two put strikes versus 8,000 the top two call strikes. And intraday, Gex is looking like 6,800 is going to be a pretty big area of support. Well, MicroStrategy getting pummeled again today, down 7.6% to 160. And so that Supreme Court ruling, whatever it's about, we don't know. Maybe tariffs, could be something else completely different. Coming up in less than a minute, potentially. Maybe. We'll see. Now, top of the hour, waiting for whatever ruling we may or may not get from the Supreme Court. Still nothing over the wires. Just about a minute after we were expecting some kind of headline from the Supreme Court, potentially a ruling on tariffs. Getting a little bit of a pull here, some volume starting to come in. 484 contracts stopped out. Still not seeing anything over the wires yet. Hang out for a few more minutes in hopes of something. Seeing some liquidity start to come back on the order book here. Is this going to be another nothing burger? It's starting to feel that way. Options flow are starting to balance out here. We see the midpoint on screen. So that gives us a sense that call volume is coming back. We also see liquidity coming back on the order book here, which gives us a sense that market participants are getting a little impatient, not really feeling like the Supreme Court thing is going to come down, or if it does, it's going to have anything to do with the tariffs. We're expecting that top of the hour. It's just about 5 past now and haven't heard a peep on any of the wires yet. So, folks, we're going to wrap it here. We gave the Supreme Court a whole 5 minutes after their supposed time to announce something. Really didn't get anything. We do see that this is a day where we've got a decent opening range. I think if anything comes from the Supreme Court that strikes down the tariffs, all or in part, it's positive for this market, so we could reclaim a lot of this trade tension loss, the tariff tantrum loss we've seen going into this week. But overall, today seems like a day where upside is largely in favor from the discounting we've had pre-market. If there's no escalation from here, I think we could end higher from where we're currently priced. And if we look at the flows overall, currently, we've got call interest starting to build up here quite a ways higher, about 100 points higher. So it's going to be worth keeping an eye on that flow and see if that starts to take the lead in terms of where the most active transacting is. We've also got the point of control and VWAP, which I think are both worth watching as a sort of line in the sand. Pushing above them gives us a sense that market participants are becoming more confident of that additional upside. If you want to learn more about my work, visit Traderade.com. If you want to get up to 40% off Bookmap, check out Traderade.com/bookmap. I'll be back next week, same time, same place, 9 a.m. Eastern, for the next episode of Back to the Futures. Wishing you all a great trading week ahead. Catch you next time.